Thanks very much. So let me start by, I hope this works, welcoming the panel. I don't think you need much introduction, so let me be very, very quick. Andreas Lehnert is Director of Financial Stability at the Federal Reserve Board already since a number of years. You are also in charge of the Financial Stability Report that the Fed brings out, so hence your reason for being here. And the same actually for Aino Bunge, who is the Deputy Governor at the Riksbank in Sweden. And also you have some experiences in this regard, and actually you have worked in many different public authorities related to supervision and financial stability, so brings a lot of experiences here. And then finally, Steve Cecchetti, I don't need to introduce you, do I?
Already.
So, yeah. So, Chair of International Finance at Brandeis Business School, and also a Vice Chair of the ESRB's Advisory Scientific Committee. So, welcome to this panel. So, I think we have excellent speakers for our topics because so in the first panel that we heard earlier, that was moderated by John, I think the questions surrounded more around why are we doing what we are doing in the financial stability reviews, and what is it that we are doing and trying to achieve. And now in this panel, we are more focusing on how we're doing it and what's actually the future of it, given that all the different changes that we see in the system. So Sarah put up a chart where you said, so what are we doing now? On the very right, you said we do communication, and then you went on to recommendation, direction. And I would think what we talk about now is on the left of that. So it's not there. So it's what we do up to coming to the communication. And what we would like to discuss today is, broadly speaking, three aspects. First of all, the financial stability landscape is evolving. It can be a struggle to keep up with developments. So think about how do we identify new trends? How can we make sure that we understand the financial stability impacts of these? Then going on to actually looking at our own toolkit. So how do these new technologies, how can they help us doing our work? And then thirdly, looking at lessons for our own communication. So with that, let me start with a warm-up question, maybe to the two central bank members here, on your views, your experiences with your financial stability reviews, and your views, what are the main gaps at this point in time? Andreas, you want to go first?
Sure. Yeah. Thank you. So, thank you for inviting me, and I'll try to make it worth your time to be between Sarah, Breeden, and dinner, both of which are going to be real high points here. And let me congratulate the European Central Bank on publishing a financial stability report for 20 years. John Fell and his boss Cornelia. When we were thinking, I don't know if you saw this in Stefan's presentation, he stole a picture from your most recent report, which showed sort of the timeline of various entities publishing financial stability reports, and the Fed was the shortest timeline on the whole thing. And in 2018, when we were first contemplating publishing it, we dealt with many of the same questions that we sort of talked about in the first panel. But I think, one question is like, why would a central bank that has no real macroprudential tools and there has kind of let's say not a lot of discussion of financial stability in its monetary policy statement, why would it want to publish a financial stability report or review? I think at least one of the reasons is because it's a way to articulate our view of a set of salient facts in the financial system, and to really sort of put all those words on paper and get feedback from the public in a really meaningful way. It's one thing when central bank officials give speeches, or you get some economist who writes a paper about something, but it's quite another when there's sort of an official publication that really tries to take a view on whether a particular development in consumer lending is a threat, or private credit, for example, other kind of evolutions, and that's kind of a place that I think not to put words in Vitor and Stefan's mouths, but there's a little bit of like when you actually sort of write this thing down in black and white and you put the seal of the institution on it, then suddenly people need to really pay attention both inside the institution and then outside it. So we found that to be a really valuable piece of our sort of ironically enough, it's a really valuable piece of our risk identification framework, because we hear, we're in the financial ecosystem. There are parts of it that are growing and bubbling, and people tell us about it. People tell us we should go look at it. We go look at it and learn things from it. So I'd say, for us at least, this is in the early stages of the Fed's financial stability report. This has been a very valuable exercise on that front.
I know from my perspective.
Well, thank you, and I'm quite honored to be here and talk about this interesting subject. But I've worked with financial stability and financial stability analysis in quite different roles. But 20 years ago, I was working at the Ministry of Finance in Sweden with legislation on banking crisis, and it was not a very prioritized project. But perhaps the FSR and Stefan's efforts there was the reason there still was a project, even though it took a couple of years until the financial crisis that we really understood the importance of it. But when it comes to the gaps in analysis and looking forward, I really think that the end of Sarah's presentation really showed how much the financial system has evolved during these years and is continuing to evolve. That we're really just in the start of technological advances, digitalization, AI, new types of money, and other forms of developments that really are going to shape our financial stability system going forward. And I think that's definitely it's going to influence both the way we do analysis, but also what we analyze. And I think since this is a conference about the FSR, I think this also relates to communications, because we're really facing a communications landscape that is much more fast-moving than it was 20 years ago. And just facing facts like social media, rumors, misinformation that is being spread through the system, and sometimes it's unintentional rumors taking place, but sometimes very intentional misinformation, including actually by state actors, and where geopolitics can have an influence on this. And that means, I think, that as with central banks, we might need to actually communicate more often to stop misinformation from spreading, and we could act as circuit breakers, actually presenting reliable information and analysis that can stop misinformation from spreading through the system and actually causing crisis. So just as was said in the prior panel, I think communication is a tool in itself, and we need to have analysis that focuses on that. But I do think there is a strong role for these regular reports of the FSR, and that communicating and being transparent in normal ties actually builds the credibility that you can use then in more fast or other types of communication. But to build credibility, of course, you need also to have the analysis and the data, and I think we'll come to that in terms of the new data we need. I think Sarah pointed out to many of these areas where NBFI is a gap, and I'm looking forward to the Suez. But I really think that this looking into the interconnections in the system and learning how different types of markets and institutions interact is really, really important. And finally, one thing is, I think there is also some kind of cooperation gap, and it also relates to the discussion we had earlier on monetary policy and financial stability. I'm not going to go into the leaning to the wind discussion, but I think that cooperation is really important, that we need to actually share information, and this is between sectors, authorities. It could be new parts when we talk about operational risk, cyber, etc. It's definitely competences that are quite far from general macroeconomic models, but I think we need to cooperate. And in terms of financial stability, it's of course important to look at the effects on monetary policy, but I also think for monetary policy, new types of financial market and institution will also affect the transmission mechanism and how we analyze monetary policy. So cooperation is definitely a gap that I think we should fill.
Thank you, Aino. Steve, do you want to take the reader's perspective,
Well,
or the academic perspective?
Well, let me start as one of the older people in the room. Maybe I can start with a tiny bit of personal history as a recovering macroeconomist. So the way I think about my role now is that I'm trying to convince macroeconomists think about finance, which means thinking about things that are in zero net supply. When you learn macroeconomics, there's this stuff that's in zero net supply, like debt, and it just disappears, right? You sort of say, well, that's probably not a very good idea. Then you go and you talk to the financial economists and you say, you really need to think about general equilibrium because it really matters. And so that's sort of where we are now. So I got into this rather later in life, and as Stefan's history suggested, as a macroeconomist, of course, I spent decades not thinking about things in zero net supply, but during the financial crisis, of course, everybody sort of had to start thinking about those things. And at that point, we started building financial policy, stability policy frameworks. That's really what we were doing, I think. And that started, I think, in earnest around 2009, 2010. And at the time, my view was that we were with financial stability policy frameworks where we were with monetary policy in about 1960.
Yeah.
So, I think, and that's kind of a problem. Okay, so if you think about it, so if I think about monetary policy, and I say, well, what happened to monetary policy? Well, 1960 monetary policy was terrible. Okay, it was really bad. It evolved into monetary policy where you had Alan Greenspan at one point that was already 25 years later saying, if you think you understand what I said, I must have misspoken. Right, sort of the intentional obfuscation. But then I think that by the mid-90s, we had a monetary policy framework, which we live with today, and you can sit here and whine about it, but it doesn't look anything like what I grew up with when I started working in the late 70s, okay? We do not want to go back to the late 70s, and we're not going back. So the question I ask when I sit here today is, how do we make sure that we accelerate this process? Now, I think we're moving faster. Okay, so first of all, I think it's not a 35-year trip. But we've seen, and what I think what we have now is we have what I would call a really, really good first generation financial stability review process here and elsewhere. The question is, can we move to the next step? And if I think back to the first panel, and I think to the comments that Stein and Vitor Constancio made in the first panel, I think that we can think about how we can do that. And it's related to some of the questions you asked. We can move on about technology later, but the uses of technology. I think what we need to do is we need to actually build some maps of the financial system. I think, Sarah, one of your slides had what I would call a sort of, very basic kind of caricature of such a map. You want to build a map of the financial system. In the EU, this is a way more complicated thing than in one simple jurisdiction, because you can have the rest of the world and it makes sense, but I'm not sure for France to have the rest of the world makes sense. We've got to have all the countries of the EU, and you have to have all of the sectors of the financial system, all of them. And then what you've got to ask yourself is, what do the exposures look like as I go from one to the other? And then you can ask questions about how you shock those systems. You may want to build in behavioral responses. It's a possibility. You don't have to start there, but I think that's where we really want to start. And that should be the next step. So the next step is figure out what data you need to do that. Okay, I actually think a lot of the data is being collected now. It's just not collected all in the same place. It's not comprehensively in the same place. Invest in the models that you're going to need. Invest in the technology, by which I mean the machines and the people to do this. And you may decide, apropos of another thing that Sarah said near the end, to use both structured and unstructured data to play this game. You probably do. And you probably also have to figure out how to increase the frequency at which you're doing it. And then you can do what I think what Stein was suggesting, which is that you can start publishing sets of indicators based on this map, and then let people decide, right? Let them use them. And that's the kind of transparency that we have in monetary policy, where in monetary policy, what we do is we try to make sure that people understand what our reaction functions are going to be. So here again, you have policy tools, you have indicators. See if you can't, I mean, we're not going to get to this point, I think, ever, because there's always going to be more judgment in the financial stability realm, because there's always more evolution in financial stability. But let's have an ideal that we're aiming for, sort of platonic version of this, that says that people actually can look and know what it is you're thinking as the officials before you, and so you don't really have to tell them, but it comes out of this building of maps that identify vulnerabilities in the system that then you publish on a regular basis. So that's where I would say, you know, if I raise it up and say, where do I need to go to build the second generation of financial stability?
Thanks, Dean. So Andreas, if you think about this building a map,
Yeah.
so where would you start, and how? I mean, in the US, you have a much more evolved financial sector, no?
Yeah.
Whereas we are more bank-based. So a lot is happening there, and I suppose this map that Steve is talking about is changing all the time. So how do you go about it?
Good. Yes, actually, my colleague Irina Stefanescu from the board is here. She works in the group that actually builds the map. It's called the Flow of Funds group. And, you know, she's been working on, no one, it was like, I'm telling you, you know, Steve, we've been working on this for a long time, okay?
Yeah.
So I think the way you articulated actually made a certain amount of sense to me. I mean, I think the way you articulated was, we're not, like, financial stability work is where macro was in, I would sometimes say, the late 1950s. I mean, I'm glad to hear that you think we're 1960, where, you know, but we don't, you know, do we have agreement on instruments? I would say it's evolving. The part that's ironic is that many of the instruments that we're using as macroprudential tools actually used to be used as macro tools back in the dark ages of monetary policy and macroeconomics, like borrower LTV limits and stuff like that is from the 1930s. So, but what you're saying is these indicators would be, in some sense, a measure of, like, the moral equivalent of the unemployment rate and the inflation rate for, you know, and people could look at that and they could say, oh, this indicator of resilience has been falling. And that's, you know, what is the reaction now? How are the authorities going to react to that measure? And are maps part of that? I think they can be. There would have to be a big modeling piece to go along with that, because things like bank capital and so forth on their own are not sufficient, you know, statistics for the resilience of the banking sector. I think where you didn't go, but where some people have gone, is the idea that authorities need to collect really comprehensive data in real time on a range of kind of financial positions, and that there would be kind of a weather forecaster of the financial system, right? And of course, in a world of forward-looking agents, not to mention the political economy difficulties in collecting that kind of information, that's always going to be, you know, that's just, I think that's a fool's errand. I also think that it's the job of market participants themselves to understand whether they're in a crowded trade or not, and, you know, they shouldn't rely on anyone else to make that judgment.
Thank you. I know, and your perspective on this. So what do we do, and how do we identify then the trends? No, because there's one issue is to look at and to draw a map where we had it at the last financial crisis or at the last financial stability event. But how do we go from there and identify where something new is happening?
Well, I mean, that's always the difficult part of it. And many of these events that actually cause a financial crisis is then like a black swan moment that actually surprises the market. But I think that being transparent and sort of increasing our analysis and moving into different areas, I think Liliana was saying in the last panel that we should teach the market. So sometimes where there's a new and evolving risk and we feel that we don't have perhaps enough analysis to actually move into recommendations or actual tools, I think it's really a good way to be transparent, because you then get the feedback from the market, other players, etc. So I definitely think that combining the new analysis with actually testing and communicating about this way of moving forward. And I don't think as a community, in talking about false positives and false negatives, us as a community, as a perhaps even risk management side, I don't think that we have the habit of communicating too early and too much. It's rather too late and too little. So I'm definitely thinking about sort of doing the analysis, but also moving forward. But one thing, this about fighting last war and moving it to new analysis, I think there are actually some wars that we haven't finished yet. So I think that we need to combine this analysis of the new risk with actually looking at the bank capital and issues like that, because you can definitely see that the wind is blowing in the other direction, and it's easy to forget the benefits that we actually had from the other crises. So I think we need to both fight the new war and the old war at the same time.
So actually, the way I say that sometimes is people accuse me of wanting to fight the last war, by which they mean the 2008 mess. And I say, yes, you're right, but this time I intend to win it.
And I think we're doing okay, by the way. We're not doing, we're not doing as well as we might, but we're doing way better.
Yeah.
But in our business, we always think, so if nothing is happening, everything is going well, then we are really concerned that we are maybe missing something.
We're definitely in the good news is bad news business here, right? Yeah.
Exactly. So Stephen, you mentioned data, no? I mean, I agree, we have there are vast amounts of data everywhere. It's just that sometimes they're impossible to combine because there are a lot of legal restrictions, and we face this, I think, within each country or jurisdiction, but definitely also internationally. So if we look at non-banks, it's a real issue that it's really, really hard to get data out there. But then also some of us have a lot of data, and it's overwhelming. How can we use them? I mean, we don't have enough people to look at all of this. Do you have any suggestions?
Well, I mean, I think that so there's a need to invest. I guess I think you don't have a choice. Let me put it that way. I think that the way I think about it is that that the official sector is in an arms race with the private sector that it can't afford to lose. And what that means is that you have to keep investing to make sure that your technology is at least somewhere close to where their technology is. Your ability to process data has to look like theirs, but then you have a lot of other data. I mean, I agree. I take very seriously the legal restrictions, and I do understand, especially how in the EU, where you want to have a single market, you want to have a banking union, you want to have a capital market, but you have restrictions on data access as you go across different sectors and different jurisdictions. So I think I understand that, but I think that that's something that if you can't fix that, I think that's going to be a really serious handicap going forward. So I think that you have to invest. And the question is how to do it. You have to learn how to use these technologies. I mean, I think some of the hope, and at this point it may just be a hope, is that technology will improve efficient processing of the data. It already has. I mean, think about the amount of data that we can process now. Again, thinking about my ancient history, I mean, I used to like plot things on paper with that I got out of books that were published by the national authorities, right? I'd open the book and you'd take the data and you'd plot the data. Now I can download the data into Excel. Maybe I don't love Excel, but Excel is pretty okay. And I think that these generative AI things look to me like Excel for words. So that's pretty good. And so I think that we can be optimistic about that. Let me make a comment about you. I made a really great comment about misinformation. I think that we have a real challenge in financial stability policy, maybe central banking more generally, in how to ensure that there's still trust. I think that there seems to be trust right now mostly, but I think it's fragile, and I'm not sure what we do to make sure that we keep that trust. but we should be thinking about that very, very seriously.
I think it's a very good point. And I think especially the much younger generation, not those in this room, but even younger,
I'm afraid the median age here is too high.
they have their information doesn't come from these official type of channels, no? So that comes all from somewhere in the social media where we have no clue where it comes from and yeah, how that is generated. So I think that's a real challenge. And so from my perspective, I would say we should continue to do what we are doing and yeah, create trust, keep trust, and not waver there. Aino, please.
Well, I think, I mean, that's a really a comment to the young generation. I think that definitely adapting the way that we communicate also about the FSR. I mean, we're trying with pods and social media, etc. But it's also interesting that the young generation, they use the generative AI. And definitely that's a new reader of our reports that's going to read every footnote of it. So at least that's a good part of it.
Andreas, how do you manage to make use of the new technologies for your risk assessment?
Well, the White House issued an executive order earlier this year, really limiting the ability of federal agencies to use generative AI. So all of our use, goes through a process, and there's obvious reasons for doing all of that. But I share Steve's worry that we're always in favor of cautious innovation or responsible innovation, but we tend to put too much emphasis on responsible and not enough on innovation. And in this kind of arms race metaphor, in a few years down the road, they'll have the AI, read our painstakingly handcrafted report. Let me just say, personally, I find, outside of my my official duties, I find generative AI to be just an incredibly useful tool. It really seems to be bringing, the power of abstraction and rigor to the written word, sort of as Steve was saying. So I think there are real sort of promising elements there. But more broadly, when you we're all in sort of the business of trying to understand how the financial system is evolving. It'll never fit into anyone's DSGE model, sort of for the reasons that Steve outlined. And there's a really old-fashioned technology which is going into someone's office and talking to them, and that but then they themselves are often they often alert us when we do that to all sorts of new innovations, and you just sort of see how they do things, how they do their work. If you sort of spend a day with someone at a kind of a cutting edge financial technology firm, it's a real eye opener.
Yeah, I mean, personally, I have to learn a lot here, so I'm not a regular user, but I should probably. And yeah.
We can give lessons later.
Well, exactly.
I have
John, I'll give you.
GPT and Claude on my phone. I'll show you.
But it's also, it will be also very interesting to see how the financial sector actually employs AI, no? And we had some market participants here for another event, I think last week, and someone was saying that they use it also for understanding market trends, prices, and so on. So really for understanding the situation, but they are not using it for making investment decisions. I found that reassuring because that's indeed where then the hallucinations would come in and where you have the crowded trades even multiplied. Yeah. So, but that's something that we have to keep up with and understand.
I mean, I think that, let me make two comments about AI. Oh, I'm sorry.
No,
two comments about AI. So first of all, I think that what the official sector should be doing is thinking about how to create AIs that monitor, okay? And create AIs that supervise and create AIs that, that do enforcement. Okay, that's what I think you should do. Here's what you shouldn't do with AIs. I heard one person stand up and say, "Oh, banks are supposed to create are supposed to create living wills, and the ones that they hand to the supervisors are 20,000 pages long. And isn't it great that I can put this into an AI and it summarizes it for me?"
And then another AI reads it.
Well,
yeah.
well, maybe the supervisor reads it, but the problem here isn't that the problem here isn't that the problem here is that somebody's given these people an incentive to create a 20,000-page living will. That's the problem. The problem isn't that you can't read it. You should never actually bother to produce it. And so I think that we do have to think about the incentives that we're creating inside of the systems, and we don't want to make it sort of easier for them to obfuscate things just because we're using AIs. Okay. By the way, people talk about AI being black boxes and stuff, and I would suggest you call my wife and ask her about my decisions. Because people are black boxes.
Yeah. But people can be held accountable in a way that,
Well.
that a machine, that was like I got that, I stole that from Sarah's speech.
Yeah, but I do think that it will be difficult to sort of draw the distinction on how our investment decisions, et cetera, are made, because I think in one way, I mean, if you're using the information from this technology to actually base your decision, then sometimes, I mean, this is a sort of a fine line going forward. But I think data, that's something that we really could do. And I know that Stephen would agree on this, that I mean, this is of sharing data that we've already collected, because of course, data is the new gold that we'll be mining. And I think that's, at least in central banks, that's something we're used to, but we also with different institutions, especially in the EU, I think that's really, even though we need regulation and privacy, et cetera, to actually share the data that we're already collecting, I think is a big step forward.
Excellent. So let us come to the third topic, and that's the communication, how we actually deal with that. And maybe I knew I could give you the floor first or so. And I mean, one issue that was already touched upon in the earlier panel was how alarmistic we should be, no? So should we, I mean, every half year we come out with a list of different risks, and aren't we too repetitive, and don't we exactly have the false alarm, and will people not at some point stop listening if we don't find the right threshold, so to speak, how to communicate on this?
Yeah, I think it's always a balancing act. It was interesting to follow the chart that John had, that you could actually see the communication at least differed between times. But of course, you want the communication to be heightened before the crisis, so that you actually then get somebody to react. But I think, like I said before, I still think that we are more likely to err on the side of not communicating. So even though you have to frame this in like Liliana was saying, in a more teaching way, I think that we need to be even more open and transparent in this landscape, with more misinformation and more channels to holding back and sort of being afraid of talking about new risks, such as AI, which is still very difficult to define. I think it's not the way forward. And I think, I mean, communication in itself, we were talking about it, can it stop the crisis that we are, it can actually make crisis not happen. Of course, we're not going to, it's hard to applaud yourself for that, because it's difficult to prove. But I mean, we had this anecdote that we were talking about before this, about the black swan, and actually, in this theory, there was also discussion about what is a black swan for in Christmas time. What is a black swan for the turkey might not be a black swan for the butcher. And I think that's one of the cases that, I mean, perhaps communication can turn some of these black swans into white swans, and that you can sort of inform the market, you can inform other participants, and also yourself. So I think communication and being transparent is really it's really the way forward. And I still think that twice a year FSR is probably a good way. I mean, data is not going to move that much between those episodes, but then you have to be prepared to communicate more often. But then you can also base that on the FSR and relate to analysis that you've done before.
Andreas, how do you see it? And did you have a similar pattern like we had? So after the crisis hit, you get more readers, no?
Yes, absolutely, definitely. Well, I was like, we've had a short publishing window, and we've managed two really first-rate financial crises in that brief time. So, really quite wearying, all things considered. Just a couple of thoughts on communication. So this black swan, white swan point is and turkey in the butcher's window is really well taken. You know, like the idea of the black swan is the rara avis. It's the thing that people thought was impossible, and as soon as they see it, they completely revise their probability distribution. It doesn't mean a big rare shock. It means the support distribution of my outcomes is totally different now. It's qualitatively, I never had to think about swan color risk. Now I do, right? And like in an ideal world, like I would, you know, I'm not sure I would die a happy man, but I would consider it a life well lived if I could just get one of those into an FSR ever once in my whole life, okay? And even then, you know, you'd say like, well, bank runs can happen to even apparently well-capitalized banks. You know, are you sure? We discussed this in the earlier session about the difficulty of precipitating a bad outcome with a mishandled communication. A couple of other things on communication. When we write our financial stability report, I really try to write it so that a really good high school economics teacher can read it and explain it to his students and have them read it. And, you know, of course we fail. I mean, we can barely understand it. You know, there are times when like a certain truth is so awkward that you just have to hedge it about with a giant block of text that not even ChatGPT could extract meaning from. But you know, other times you just really need to try to say what it is that you're trying to say. Okay, and then finally, you know, on asset prices and there's a big section in the Fed's financial stability report that talks about asset prices. In part, that's because we have a lot of people who understand, you know, asset valuations and who do a lot of thinking about it. In part, it's a part that changes a lot, but you know, we go to extreme lengths to be clear that we're not, you know, we're really not making a buy or sell call on financial markets. And I think it's really, really important that financial stability reports not become your Wall Street newsletter, your investment advice newsletter. No one necessarily suggested that, but that's sort of come in and out of vogue over the years.
A few points. So first of all, I think it's really important that we always keep in mind that while you do have to manage crises when they come along, the job of a financial stability report and the job of a financial stability unit inside of a central bank is, in fact, to identify vulnerabilities so that you mitigate crises. You want to reduce probabilities, okay? And that's actually something that is going to be pretty persistent, it turns out. If you start looking at it, you think about it, it just doesn't change that fast. Now, sometimes things change. I mean, you know, March of 2020, we all went into our basements, but suddenly, one week. But the point is that by and large, those vulnerabilities do not change that fast, and the shock distribution doesn't change that fast. Oh, let me compliment the FSR of the ECB in distinguishing between shock distributions and vulnerabilities or amplifiers, because I think that's always something that you want to make sure that you keep in mind, because those are very, very different things, and they can each change independently. The second thing is that I think that in thinking about communication, I think the biggest challenge in financial stability policy is a combination of the fact it's the fact that what you're talking about are unlikely events, but they're unlikely events that are not in the human experience very frequently. So if I tell somebody they have to buy automobile insurance, they're going to sort of say, oh, okay, you know, I'm not going to crash very frequently, hopefully, if ever, but I do see people crashing. And you say, well, you have to buy fire insurance for your house. You say, well, you know, my house isn't going to burn down, but I do occasionally, you know, I look at the news and I see a house burning, okay? Now, unfortunately, we don't see this, and the whole idea is to not see it, but then we tell people they have to pay insurance premiums for it, right? And that's a hard sell, and it becomes a harder and harder sell the more successful you are. And so the question then is, how do we educate people so that we can help them to understand that that's worth it. Now, Ernst, I'm afraid I'm not optimistic about financial literacy. I think we have to run policies under the assumption that people will not understand them generally. I would love to be able to teach everybody, you know, to teach everybody what an interest rate is, for instance. Just let's start there. But anyway, but I do think that we have that I think is the other communication challenge, and it's not unrelated to remaining credible. Is how do you convince people that they need to keep paying the price for something that they never see?
Okay, so going forward, what's your view? Do we need to change our financial stability reports? Is there any structural challenges that or changes that you would think are there? No, both of them are given our ability to generate data and to work with that, and but also in light of the fact that maybe the habits of our readership changes. No, I'm convinced that fewer and fewer people will read through the 100 pages over time, and maybe some still do, but maybe is there also a need to reach out to other type of audiences? Any youth, any thoughts?
Well, I would say, I mean, we do adapt it, of course, making it shorter, but also this layering where you sort of, I mean, using the technologies we have, we sort of link into other words. So I think that's one part of it. But then it's also a question about not making it having too many purposes as well, because I think that if you try to make it educate the general public and as well, you have to have some kind of sort of meaning. And this is still going to be twice a yearly assessment of the financial stability in the region or country, etc. So I think that there's also a need to keep some kind of stability around that publication, and then maybe adding other types of communications, etc. on the way.
I mean, we have a podcast, right? Do you also have a podcast?
You can put your financial stability review into Notebook LM, which is a product of Google, and it runs on Gemini, and it will create a podcast for you. And I recommend, I like strongly recommend that if you have not done this, everybody here, you should do it, because it's unbelievable what it does, what it creates. And I think that we're going to use stuff like that for communication. Is we're going to be taking our documents and we're going to be creating 10-minute podcasts out of them. But that's not what I was going to say to answer to this point. I'm sorry, go ahead.
I mean, I think, you know, as the publisher of the youngest document, you know, on the slate, like, I'm just happy that it's, you know, we still managed to keep the thing going so far. But I could imagine, you know, sometimes we've been lucky with the timing. Financial crises have broken out about a month before we've published one of these things. I could imagine, you know, getting comfortable with just a much more rapid kind of articulation, like when events happen, you know, coming forward, you know, bringing this, like publishing the moral equivalent of a box sooner or something like that, and everybody understanding what, you know, what that means. Just feels like of all the things that are changing in this world, you know, moving to 24/7, you know, by 365 payments, you know, waiting for this like pageantry of the financial stability report to come around. Maybe that's something, that's a margin that we could be flexible on too.
And in terms of topics, is there anything you would change? I know we are all very slowly adapting institutions, but if you were looking forward, is there anything that we should change? I mean, of course, there may be financial market trends that are not yet covered or are yet too small. Another question would be about, it came up in the earlier panel, stress testing. No, should we publish more? Is there room for that in the FSR?
I can take a stab at this. I mean,
Yeah.
I know, like, you know, that you and Tara and everybody have been thinking about the resilience of market liquidity. And, you know, does this represent, is there some, maybe this is a little bit to getting to Steve's point, you know, can we start, like, you know, adding chapters and sections and getting people sort of comfortable looking at a particular set of metrics that, you know, articulate clearly, you know, are these liquid markets and is this liquidity resilient or not? You know, right now it feels like, you know, it's a central limit order book and it's very, very complicated. And there's some, you know, some artifacts that come out of that, which some people understand. I think high school economics class in Topeka does not understand it. And then, how resilient is that? And there, I think, we don't have a lot of theory to go on. So that would be, in some sense, that's like, we think about that sometimes as the fifth vulnerability in a framework.
Okay, I know.
I think that sounds really interesting, but also, I mean, looking at the system-wide perspective that this was, I mean, that sounds like a way for the future. But I just wanted to come back to this with the report and sort of the internal use of it as well. And it relates to Stefan's comment in the beginning that it's also a way of creating accountability and actually forming a joint opinion. So, I mean, if you compare to other communication, it will not be that same process of having the board actually agree. I don't know if we'll publish minutes, but at least it sort of forces you to come to a joint view on the way forward.
I think that what I would do is, I would say that what you want to do is publishing things related to stress tests on a regular basis makes sense to me. And I could imagine something like reverse stress tests as an indicator, or something like that. Like, how big a shock do I have to put in to get a certain outcome?
Yeah.
Again, I have to have this map. I've got to have this model that's going to be layered on top of it. I'm going to have the data, and I could actually even do this a little bit more frequently, probably, than every 6 months. But then the idea is to say, okay, either what's the outcome from a standardized shock or set of shocks, vector of shocks, or how big a shock do I have to put in to get a certain outcome? And I think that doing that on a regular basis, again, as something to aspire to, would be where I would be aiming.
Okay, so we are spot on. We have time now for some questions from the audience. Raise your hands. Yeah, over here then. Over here in the front.
Livio.
So it's more a suggestion than a question. You mentioned this product by Google that can you upload your paper and it's going to create a podcast. So what you maybe don't know is that they're able to do that, a good podcast only for papers that are well written. So I did a test for a paper that we published in the journal, and the podcast was crystal clear. I did the same with a very rough working paper, and the podcast was super off. So put your FSR in the podcast and see what's going on.
Well, let me just say that. So, I mean, I can send you all links to this. I put 20 papers on AI and financial stability into it, and then I asked it to make a podcast on AI and financial stability. It's about 6.5 minutes long, and it's spectacularly good. I could never do as good a job as this. It was very humbling. Livio, right there.
So thank you. So although I've been kind of reading financial stability reports for many years, I've really paid a lot of attention more in the last 2 years. I rather new, unlike many of you, I rather new to the business. And so two things that struck me. So one is that, so we know that most financial crises and so on, they come from the housing sector. So they come from mortgages. I think 9 out of 10 crises come from there. And I don't see this ratio really reflected in the financial stability reviews. I mean, we speak a lot about markets, we speak a lot about the sovereign markets, derivatives, all kinds of things, but the idea that, that we really should be looking at the housing market, and this is the suspect number one, is not, so there is, I see a dichotomy between what the history tells us and what the financial stability reviews typically say. So that is one thing that struck me, or it continues to strike me now. And the other issue is that perhaps, in terms of language, I find many financial stability reviews too much a kind of a list of things that could go wrong. And at least part of it is also a bit like kind of a reputational game. So if something happens, we can always say, in footnote 34, on page 134, we said it. And I'm not sure that this is really, I understand why we as policymakers or bureaucrats, we want to do that, but if I was a citizen and I entrusted public officials to do a job for me and I pay these people to do this, I personally would not like people to do that. I would really like people to think about, what can go wrong and what will I do if things go wrong? So the resilience. So this is what, as a citizen, I would pay people to do. So do you think that this second aspect is also present, and how do we deal with it? This kind of reputational game. Thank you.
Thank you. Who would like to go?
Well, I can say something. I think that at least in Sweden, we write a lot about housing markets, and that's a bit about fighting the last war is still ongoing. So that's that is something that I think continues, and it brings me to something about macroprudential policy. When we talk about having structural or cyclical instruments, I think we really have to think about the political economy. It's always going to come in there. So just put something in place and leave it there for a while would be my advice on that. But I mean, I definitely agree. This just putting out the risks and a long list. I mean, clearly it depends on the mandate of the central bank, how far you can go. Like Sarah said, if you have a lot of steps that you can take, some central banks have less steps, and then communication and sort of pointing into, but at least you can give recommendations and say something about what needs to be done about the risk, and not just highlight that there might be a problem. I think that's a good way.
So I think that I view your comment as I think it's I think it's accurate. It's also a sign of what I think of as a pretty resounding success in creating a system where there are backstops of various kinds that keep the crises from actually being amplified in other parts of the system. So if I had asked the question of what is it that causes financial crises in 1900, I think your answer would be different. But that 1900's a period, so there were, I believe, if I remember correctly, there were 18 central banks in the world in 1900. The United States did not have one. And as a consequence, there were a lot of banking crises. And that's because there was no lender of last resort. At least that's what we think. Maybe we're delusional, but that's what we think. And so the point is that we've managed to stop a lot of this other stuff, and it doesn't create crises anymore. Now, our worry, and that's what Sarah just spent, I think, half an hour helping us to try to understand, is maybe there are places where we have to be looking where we don't have the backstops, where we don't have the where we don't have the guardrails that are then going to cause those crises to arise. I don't know the answer to that. I think it's the job of people in financial stability to look, though.
I have a thought here. In 2005, when I was looking at the housing and mortgage market in the United States, that was my job back then. And trying to think like, gosh, if it all goes wrong, is this going to be a problem or not? People would ask, like, well, what would cause house prices to fall 20%? Or what's the likelihood that house prices would fall 20%? And that, as you know, our framework now really tries to be very religiously agnostic about what the shock that might hit the system is. And we try not to provide laundry lists of risks. But the reality is that, as everyone else knows, is that policymakers, they're not really interested in your highly theoretical view of the resilience of the financial system to a series of generic shocks. They want to know, look, geopolitical uncertainty is spiking. There's all sorts of stuff going on. I mean, we saw Sarah's, very vivid picture in not AI generated picture in her talk. So I think we have a process now where we really are picking up just the 2 or 3 most salient events and trying to think very carefully about them and how they would play through the system, rather than, really just trying to articulate everything that could go wrong. And on this housing point, in the financial stability world, as you know, we just don't have that many financial crises. And when we look through history, there are only certain variables that we have good, time series cross-sectional data on. And, kind of housing, banking, credit, it's one of those variables. And so there's a little bit of a sense that, if you go back to country X in year Y, was that really a housing bubble? Or is it just that we measured bank credit and sort of house prices and those things moved together and then there was a downturn? So I think, I think we're all suitably agnostic about whether, real estate might not be implicated in the next downturn. Of course, that said, we can all think of countries in the world that are having major real estate crises right now.
Thanks. Stein? Then.
My question was a little bit of follow-up to Livio in terms of the coherence, because when you start expanding yourself outside the area where you have jurisdiction, you're going to be crying wolf, so maybe housing in Sweden. How often do you do that without losing credibility? It's like if I were to be writing financial stability reports in 1900, I say, oh, there's a banking crisis coming for 15 years. You're going to be out of business after 10 years because people tell, well, we don't like you. So. And that's even, let's say, cyber risk. I mean, what are we going to do about cyber risk as a regulator when it's state actors or whatever you have? So how do you look at that? Do you deliberately take topics off the table? Do you do it once every 5 years and then you say, okay, let's leave it to the other guys? I washed my hands. Any advice?
Well, I would say that you need to at least keep the topics that are closely related to the financial sector. So of course, something like pandemics or having, I mean, even war, since we're dealing with that also in creating resilience, but I don't think it really is sort of a more of a trigger event. But when it comes to housing and cyber, those are so closely related and really, so I think that you still need to talk about those and actually follow developments in those, even in the financial stability report. So I mean, you always have to draw the line, but I think those two are just too closely related to the financial stability.
I think that I think if you have a disciplined process, which I think people do, you have a sense of what it is that pushes something up the list and what it is that pushes something down the list. Okay. Now, I think one of the problems, which may be related to your question and to Livio's question, is that the list is always relatively riskier. Okay. We don't have good measures at the moment, but we're advocating maybe trying to generate them of absolute measures of risk, right? The same way we do, we have a sense of what a high unemployment rate is or what a high inflation rate is. We have a sense that, risk A is riskier than risk B, but I think you do need to have a disciplined process of what, I kept asking people, how do you take something off of the list?
Yeah.
That's always my question. I want to know, I don't want to know how you put it on there. That's easy. I want to know how you take it off.
Very good question. Last question. Oh no, the last two questions. Please. Sarah, go ahead.
Well, why don't I ask mine? Then I'll pass the microphone off, and you can choose which one to answer. I think one of the themes has been, how do we remind people of the value of resilience? Another theme has been, how do we decide which of the laundry list is the one that we're going to shout about? I do think that stress testing is a really helpful way of trying to prioritize, trying to remind people of what we're trying to avoid. And I just wondered what reflections you each had on where we needed to make stress testing better, whether we needed to move from stocks to flows or to different issues. It seems to me that stress testing has got the potential really to help us here, but we don't have the maturity yet. I don't think we want. So your thoughts on that would be great.
Not so much a question, but a statement. First of all, I have dealt with 17 years of monetary policy minutes, and it strikes me that if you read all those minutes, uncertainty is always unusually high. And no one has ever tried to check, sort of, you can probably do it today with AI to see when it was correct and when it wasn't correct. But it's something about the human mind and difficult to deal with. my other reflection, and this is absolutely not for a box in a financial stability report, but it's something which is well worth researching. And it has struck me over the, again, many times, and you have touched on it briefly here on this panel and earlier today, and that is that the political economy of financial stability is seriously under-researched. Because all the individuals on these panels have talked about financial stability from an economist's rational perspective. But when you combine that with various political processes, then you sometimes end up with completely different end results.
I have to sell my 2013 paper with Greg Felberg and Doug Elliott on the history of American macroprudential policymaking. Yeah, where we went and looked up the old Nixon administration archives and what they had to say about we would consider to be like a very modern macroprudential scheme. It was really very, I'd say the debate was highly contemporary.
Any final thoughts on the other topics?
I definitely agree with Sarah's point and summary, but just in the case of stress testing, since we're then moving into system-wide exercise, there's still a lot of data gaps, etc. So there's a while until we can really use that for policy conclusions, I think. So definitely work more on it, but until we're a bit further, I think it's always going to be a challenge to translate the financial system into one exercise.
I'll just agree with Aino. I think the more people that we can get trying to build frameworks that can do system-wide stress tests, the happier I'm going to be, because that's what we need to see. I mean, it's great to see bank stress tests. It's great to see bank liquidity and capital stress tests. It's great to see stress tests for insurance companies and stuff. But I want to see like the whole thing, because otherwise I have no idea where the vulnerabilities really are. So it's exactly the slide that you put up, just to keep going in that direction.
Yeah, no, thanks indeed for the question. I couldn't agree more on that. And also that we should really move away from having one scenario. No? So, I mean, we have the big EBA stress test, obviously, where it's hard to have more than one scenario. It's a lot of work. So, meaning that we have to have more top-down, more agile way of dealing with different scenarios. But it's yeah, it's not an easy way forward. So time is up, right on time. And yeah, that was a very nice session. Thank you very much. We mentioned in the whole afternoon, I think, to mention geopolitical risk only once. And this is why the mood is so good in this room. And now we can have a reception. Starts at 6:30 right next door, I think, and then go on for dinner at 7. And Vice President de Guindos will give a speech. Great. Thanks very much.